Somewhere in Canada this year, more than 1 million people are going to open an envelope from their bank, and their stomach is going to drop. It's not a late notice. It's not a scam. It's just a mortgage renewal, the most boring piece of mail there is. And for the largest group of homeowners in this country's history, all hitting at once, that boring little letter is about to add $500, $600, $700 to their payment every single month. Here's the part that makes this different from anything else in the housing crisis. These aren't investors. These aren't flippers. These are ordinary people who never sold, never speculated, never did a single thing wrong. They just own the home they live in. And a clock they forgot was even running has just hit zero. Today I'm going to show you why over 1 million Canadians are walking into this wall at the same time, the trap that keeps them from escaping it, and what it actually means for your money. Let's get into it. So let's talk about the number in the title, because it's real, and it's landing on real kitchen tables right now. Here's how it happens. Back in 2020 and 2021, interest rates fell to almost nothing, and millions of Canadians did the smart, responsible thing. They locked in a 5-year fixed mortgage at around 2%. 2%. It felt like winning. But here's the thing about a Canadian mortgage that a lot of people forget in the moment. Unlike in the United States, your rate is not locked for the whole life of the loan. It resets. And for that huge wave of people, the reset lands in 2026 at something closer to 4.5%, maybe 5%. On a typical home, that's an extra $500 to $700 a month. The math doesn't math anymore, and nobody's income magically went up to cover it. Now think about what $600 a month actually is for a normal family. That's a car payment. That's a month of groceries. That's the kids' daycare. It's not a rounding error you shrug off. It's a hole that opens up in the middle of a budget that was already stretched tight. This is absolutely brutal for people who thought they'd done everything right. And it's already happening. On a personal finance forum, one homeowner described their renewal in plain terms. Their rate went from just over 2% to nearly 4%, and their payment jumped 21% overnight. Not because they missed a payment, not because they took on more debt, just because the clock ran out. Thousands of people are sitting in that exact spot right now, staring at a new number they didn't choose. A broker in Ottawa put a name to it that stuck with me. He said for a lot of households renewing a 5-year fix this year, payments are rising roughly 15% to 20%, and in real terms, that's $400 to $600 more every single month. And a realty broker on the news walked through an average $500,000 mortgage and landed on the same place. About a 20% jump, around $550 more a month, which works out to over $6,000 a year. That's a real vacation. That's an emergency fund. Gone to the same house you already own. Now, to be fair, and this matters, this is not everyone, and it's not the apocalypse. Canada's mortgage arrears, the share of people actually falling behind, are still very low, well under 0.5% nationally. Most people will find a way to absorb this, painful as it is. So this isn't a wave of families losing their homes, but a bill you can't avoid, landing on more than 1 million households at once. That's a different kind of pressure. And there's a reason so many of them can't just shop around for a better deal. Because here's what your bank would really rather you didn't figure out. When that renewal letter arrives, you might think, fine, I'll just take my mortgage somewhere cheaper. And for a lot of people right now, you can't. There's a trap built right into the system that quietly locks you in with the very lender charging you more. They call it the mortgage prison. Let me show you how the door closes. Here's the mechanism. Almost nobody understands until it's too late. In Canada, if you want to switch your mortgage to a new lender at renewal to get a better rate, you usually have to requalify. You have to pass the stress test all over again, proving you could afford payments at a rate even higher than the one you're being offered. Back when you first bought, You passed that test at 2%. Now you'd have to pass it at today's much higher numbers. And a lot of people simply can't. Their income didn't rise enough, so they're stuck. And here's the quiet cruelty of it. Your current bank knows you're stuck. They know you can't leave without passing a test you might fail. So the renewal offer they slide across the table doesn't have to be their best rate. It just has to be better than nothing. Translation: the most loyal customers, the ones who can't shop around, can end up paying more than a brand new customer walking in off the street. That's the prison. You're not behind on anything. You're just locked in. It gets more expensive in the fine print too. One homeowner shared their renewal online. Their bank offered to drop their rate, sure, but only if they let $5,000 get tacked onto their mortgage balance and paid almost $4,000 more up front. So the better rate came wrapped in thousands of dollars of new cost. That's the kind of thing that happens when the other side knows you don't have anywhere else to go. So why does this clock exist at all? Why do Canadians get blindsided by resets that Americans, with their 30-year locked mortgages, mostly don't? It comes down to how our system is built. Short terms, usually 5 years, that force you back to the table again and again, at whatever rate the market happens to be at that moment. When rates fell to nothing in the pandemic, that felt like a gift. But it also loaded the spring. Everyone piled into cheap 5-year terms at the same time, which meant they'd all come up for renewal at the same time. And if rates were higher by then, they'd all get hit together. That's exactly what's unfolding now. And there's a nastier version of this trap for one specific group. Some people took variable rate mortgages with fixed payments, meaning when rates shot up, their monthly payment stayed the same, but less and less of it went toward actually paying down the loan. For a big chunk of those households, the payment didn't just rise at renewal. It had to be reset dramatically, because the balance had barely moved in years. Hundreds of thousands of families are walking into that specific reset. And for them, the jump isn't 15%. It's far steeper. Now, to be fair again, let's keep this honest. Canada's most quoted housing economist, the deputy chief economist at CIBC, has been clear that for most people the increase is in the 10 to 20% range. Painful, but not the doubling some feared. It's a smaller slice, around 5% of mortgage holders who face the truly brutal jumps of 40% or more. He called this the biggest test the mortgage industry has seen since the 1990s. But a test, not a collapse. Holding both of those things in your head at once is how you actually understand this. And here's the number that shows you the sheer scale of it. This isn't a few unlucky people. More than 1 million mortgages are renewing this year alone. The single largest renewal cohort in Canadian history, representing hundreds of billions of dollars in home loans, all resetting at once. But before you assume everyone's doomed, there's a twist the headlines keep getting wrong, and it changes who should actually be worried. Here's what almost nobody tells you. Not everyone renewing is getting crushed. Some people who took variable rate mortgages are actually about to see their payments fall, because rates have come down from their peak. So for a slice of homeowners, this renewal is relief, not shock. The story is genuinely split, and which side you land on depends entirely on what you signed years ago. But there's a deeper trap hiding underneath, and it hits a very specific person. Someone who bought near the top of the market. Here's the problem. In the Toronto area, home values are still down roughly a quarter from their peak. So imagine you bought a condo at the top, and now you want to renew or refinance to pull out some breathing room. You can't, because your home isn't worth what it was, and the bank won't lend against value that's evaporated. One analysis found that a typical owner in that spot might need tens of thousands of dollars in extra equity just to qualify, money they simply don't have. So the people who bought at the worst possible time get hit twice. The payment goes up, and the escape hatch is sealed. You can hear the human weight of it out west, and back east, and everywhere in between. This isn't a Toronto-only story. It's a national one. because the pandemic rate cut was national. A homeowner watching their renewal creep closer wrote that, between the higher rate and a market that won't cooperate, they just want to sell, take their loss, and start fresh as a renter. That exhaustion, that's the real sound of this crisis. Not a dramatic collapse. A slow, quiet squeeze on ordinary people who thought they were safe. And here's the comparison that keeps us honest about how bad this really is. Look at Australia. Same kind of rate shock. Same anxious homeowners. But there's a real difference in the hard numbers. In Canada, the share of people actually falling behind on their mortgage is very low, well under 0.5%. In Australia, after a run of rate hikes, more than a quarter of borrowers are now flagged as at risk of mortgage stress. Now, those two numbers measure slightly different things. One is people already behind, the other is people feeling the strain, so we hold them carefully. But the honest takeaway is this: Canadians are stretched and stressed and squeezed, but so far, they're mostly still paying. This is a story about pressure, not yet about collapse. And that distinction matters, because it's the truth. So let me talk to you directly, wherever you're sitting right now. If your renewal is coming up in the next year or two, do not wait for the letter. Start talking to a mortgage broker now, months ahead, so you walk in knowing your options instead of taking the first number your bank offers. If you're on a variable rate with fixed payments, find out exactly where your balance actually sits, because that's where the biggest surprises hide. If you bought near the peak, know that you're not alone, and that a broker can help you understand what's actually possible before you panic. And if you're a renter watching all this, understand the pressure to rush in has genuinely eased. Here's the truth. More than 1 million Canadian homeowners are renewing this year, many of them jumping $500 to $700 a month on a home they never planned to leave. Squeezed by a clock most of them forgot was ticking. It's pressure, not collapse. And knowing the difference is how you get through it with a plan, instead of fear. I'll be covering exactly where this heads next every week. Subscribe to this channel so you don't miss it. Thanks for watching. See you in the next one.